Hi, it's Greg here, and I'm doing a follow on for the weekly update. And this is to just kind of do a macro zoom out. It'll take 5 or 10 minutes here. So, the point I want to make, I just talked to a client, and the client said, Greg, I didn't really understand, you know, your total positioning. So, I'm in cash. That's where I'm at on this date. What I want to talk about is the current situation in the market, and I hope by giving you some personal examples, you can think about this differently, and then hopefully that will help. And we're going to start here with this 1975 Mercury Marquis station wagon. And back, I'm going to say 1976, this car was beautiful, right? It had the headlights that opened, and it had the power windows. It just started to be a thing. 460 motor, it was big. And we were driving back from Torquay, Saskatchewan, middle of nowhere, north of North Dakota, and we were driving across the Trans-Canada Highway, and it was going to be a 12-hour trip. And we were driving, and it was starting to be a snowstorm, and we were trying to beat the storm. So we left early in the morning, and there's 7 of us, so 5 kids and 2 parents, and we're piled in the station wagon, and we had a box on top holding our luggage, and the car's jammed, right? And it's cold, and there's snow blowing, and so we start off, and we drive for, almost 2.5 hours just to get to the Trans-Canada Highway. And then as we go, the snow is getting more intense, and at the time it's a single lane road each way, no median, and so we're driving along, and the snow's blowing, and it's getting worse and worse. And we continue on, and Dad only stopped once on the 12-hour trip. So when you had to go to the bathroom, this was your chance. And then we packed sandwiches and everything, and so we're rolling along, and we're using this Mercury Marquis station wagon to beat the storm. And Dad was a quick driver, so as we drive along, the storm's getting worse and worse and worse. And the snow drifts are getting bigger and bigger. And we finally make it to Highway 9, and now we're going to turn off the main highway and turn onto a secondary highway. Well, guess what? That goes north-south, and so now the wind is coming straight across that highway, and the snow drifts are getting bigger and bigger. And then we turn onto a smaller road, and on that smaller road, it's gravel, and we're going through these big coulees, and the snow is easily drifting over the road. And now it's late at night. It's almost midnight. And we're trying to keep going. We've got about 10 miles left to go. And as we're driving along, these snowbanks get bigger and bigger. And we're pushing through, and this car's just an absolute boat. It weighs so much. So the snow's flying everywhere. It's late at night, and the headlights are all trying to shine through the powder snow as we're blasting through these snowbanks. And we hit another one, and then we hit another one, and then we turn the corner onto an even smaller road, and this one again north-south, so the wind's coming across the road. The snowbanks are getting bigger and bigger, and we hit another snowbank, and we almost got stuck, but we managed to make it through, and we're about a mile from home, and we continue to drive on, and we hit a snowbank, and we pop through that one, and we get to our driveway, and we're about to drive into the yard, and the car comes slamming to a halt, and it's like 10 minutes to midnight. And so that's fine. So we unpack our stuff out of the car, and we hike to the house through the snow, and it's 3 or 4 feet deep. And we get up to the front door, and our dog had been just running around the farmyard. And we open the door to the house, and we walk in, and the taps were shaking, and we couldn't figure out what was going on. So Dad put his hand on the tap, and it burnt him. And what happened was the hot water tank had the temperature gauge had failed, and so this tank just kept heating and heating and heating, and the whole house was ready to burst. And so we opened these taps, and the hot water was shooting through the house. It was literally almost boiling. And so just after we thought we'd made it, right, we're finally home, we walk into the house, and then there's this near explosion. But the house didn't explode, but everything obviously was under pressure. And so we made it through. And my point of that little story is to just say we're going through snowbank after snowbank after snowbank, and it's risk on and risk off and risk on and risk off, and we're just continually pushing into a headwind here, a bigger storm. And what we don't know is if we're going to get there before the hot water tank blows or after. And what I want to talk about today is why I think the problem is setting up right here, right now, this week, and we need to just be very, very careful. So the explanation I had used was that, I feel like we're a rooster on top of a hot tin roof in Phoenix. You don't want to stay long. You're going to get cooked. And the issue we have here is all of this data that I have compiled into what's called a recession watch list is sitting here. So do I know if it's going to happen this week? No, I don't. But I'm just telling you that all the clues are lining up, and these charts come over and over and over and over again. And so we're going to start here with my strength indexes are breaking down. And so what happens on my strength indexes is they basically measure momentum, and as the market continues to go higher here, they're getting weaker. So that's fine. But what's really going on underneath the surface is this is measuring how many charts are continuing to go higher, or how many industry groups and sectors and that kind of thing are going up. And as they start to roll over, this chart gets weaker. And I've got 3 different timelines, so that's why there's 3 different lines at the bottom here: blue, red, and green. And up at the top are the 2 indexes, the S&P 500 and the NASDAQ 100. So the point I want to make here is my indexes are getting weak. The chart is still okay at the index level. So here's the Fed funds rate. And again, we are sitting above where we were in 2019. And as recently as this week, and Jim Bianco did a really nice video about this, about the change, the sudden change in investment managers' expectations around interest rates and how high they might go. And now they're targeting higher than the 2006, 2007. They're starting to come into the level that we might actually get to a 6 handle before the Fed stops. So this is rapidly changing, but my point is we've already gone through this sort of a vertical spike for a year, and the interest rate changed from literally 0 or 0.25%, and it's gone up. So based on that low number, the percentage change is huge. Even if we started it at 1%, we're still moving up faster. Like we're moving up at 400 or 500% this year, instead of, kind of our max before was 200, and that's when the economy broke back in 06. And in 2015-16, we had a problem where crude oil plummeted. That also was a period of the Fed raising rates, trying to raise rates, and it wasn't able to do very much. But the issue I want to point out here is the Fed is still a problem for us. They're ahead of us, and which snowbank they are in, I don't know how many snowbanks we have to go through, but we're trying. And so the issue for everybody, we need to be aware of what's going on. So I have this watch list called Recession Watch. And this is called, this is the gap earnings. So we're up here, we're well above the red line. So the red line is 20 times earnings, the green line is 10 times earnings, and the blue line is 15 times earnings, and the purple line is what we currently are. So we're way up here. And you can see back, in 2000, when we had the tech boom at the time, and we've just had the SPAC boom. But as that unwound, we started to fall off pretty hard. Here we sit in 2007, 2008, 2009, and things started to fall off pretty hard. Risk happens fast, and my point is a lot of these charts are sitting here ready for change, and we're still sitting at a very high level relative to history and the way things are currently set up with the Fed. So here's the Baltic Dry Index, and I've been covering it in my newsletter recently, but the momentum for the shipping rates, and it doesn't go to 0 ever, but you can see they were crazy, and then they've been dropping steadily. And now we're back to a level that we got to in 2015 and 2016 as part of the big pullback then. And January 25th or so was when crude oil finally made the low. And then in 2020, we got down to these levels. And really, this is unheard of levels. But if you look at the momentum indicator, only in 2020 and only in '09 did we have this much negative momentum for something like moving goods across the ocean. And this is dry goods, so think copper, fertilizer, that kind of stuff. So here's another one, personal consumption expenditures. And my PPO momentum indicator is just rolling over on this one, so it doesn't look like anything here on this big, huge chart. But what we're seeing is the momentum is just signaling now, just went negative, that the personal consumption is starting to roll over. Okay, so that's one more thing. So here's housing, and this is another one. Basically, if you stay above the green line, that's a good thing, and if you're below the green line, that's bad. Well, you can see since the 70s, we've gone through some pretty big momentum cycles. We've just gone negative. In all of the good markets, this doesn't go negative. But here we are, this thing's dropping, and it's dropping very, very quickly. We had the 2020 spike down. But the 06-07, when interest rates were starting to get up around 5%, this is how this rolled down. And it was pretty quick and meaningful, and it was, pretty much a consistent drop all the way to the bottom. So it's at least something to be aware of, but it's just one more thing. And again, Baltic Dry Index, we've got all these different things, personal consumption. Now, here's another one. This is industrial production. And by the way, on this housing, I could go to single family new homes sold, and this chart's been declining for a while. PPO is still trending down. Let's just say it could bounce up, but we can look back in 80, 82 when the Fed was trying to control interest rates, what was going on here. And we kind of got a false dawn, and then we rolled back down. And it was a pretty meaningful place. So anyway, so we're sitting here, this chart is breaking down, and we're trying to bounce. Cool. Now, here's industrial production. Well, industrial production is about to go below the green line again, in this case, the 20-month moving average, and holding up till 2008, and then it fell apart here, and you can see it went negative. And in 2001, so it didn't top in 2000, it didn't go negative in 2000, it went negative in 2001, and then stayed down there for a long time. But it takes a lot to change the direction of industrial production, and here we are with a PPO sell signal and industrial production rolling over. So this doesn't look very good. Now again, just another snowbank. So here's the University of Michigan consumer sentiment. You could just see that when we're below 70, it's really not that good. And here's the 08-09 period where we bounce around down here for a while. And then the Fed was trying to get things going again, so then they were helping the economy. That is not the case here. So anyway, just if you use the green line in '01, we started to fall below. Well, we've been going below this thing since COVID started. So we're still negative. And again, things are trying to improve. I get it. I'm just saying, so if sentiment's so good, why is personal consumption starting to slow? Okay, so here's semiconductors, and we're right at a level of resistance, which I think is kind of important, and we could go higher, but it's another one that we just need to keep watching. I could have circled in here too. I'm just saying at this level, this is where the rallies have stopped for semiconductors. Before, we've spent 3 weeks here, and we don't really have a whole bunch of momentum. And again, my strength indexes are already pointing south. So here's a really big chart of the S&P 500. And what you see is this big, giant uptrend, and we've cracked it, but we're trying to hold in here. And if you look down here, this is the RSI, the Relative Strength Index, for those that don't know what that means. And essentially, when you're in a bull market, it stays above 40, it stays above the green line. And when you're in a bear market, it stays below the 60 level. So here we are bouncing down in 2000, 2002, and we stayed down here for quite a while, and then we finally got our momentum back. 08, 09, and again, the Fed came in to help create this bottom. 11, the Fed came in. 2015, the Fed came in. 2018, the Fed came in. 2020, the Fed came in, and now there's no Fed. So we're sitting here with this red line well above us, and we're starting to tick down on relative strength. This is a weekly chart, so what I want you to notice is we're negative, and we're just trying to get through the zero line. But what happened in 2000 was we kind of got down here, rallied up, and once we got to zero, and then we failed again, and we rolled right back down. So here's '08, and same thing, we rally up and we try to get everything going, and then it fails, and we start to break down. And both of those breakdowns happened in the spring. So, but we're in a different period, right? This time it's different. So something very different going on here. So here's U.S. Manufacturing Index, and it's been below 50 here for a little bit, but we're now at 47.4. There's no sign of this improving yet. Here is the Chicago PMI, and we're below the 50 level, and we have been for a while. So that's the Purchasing Managers Index. If we go to the leading economic indicators from OECD, the Organization for Economic Development, what you see here, here's the G20, and we're near the lows. But again, in 2009 is when we got down to this last level. Other than COVID and 2020, the year 2000, we were down near these levels. So this isn't very positive, but from the lows you turn higher. That's where it starts. So everybody thinks we're already on our way higher. I would just say in 1980, we came down hard when the Fed was trying to control inflation, and we're sitting here. That was one of the worst dips on the whole chart, and yet we're still going down. We haven't even had a ripple yet, and we're near this, I'll call it the lows that we hit in 80 or 82. It's a place to watch. And then here's the wholesale inventories. Well, we're about to go below zero here. And when you look on this chart, going back in 2000, again, it didn't happen in 2000. It happened in 2001, 2002 is when this chart really started to go negative. It happened in '08, '09. In 2015, it was just kind of hanging around that level, but we're not like hanging around this level. We're plummeting down to this level. So all of this adds up to just say, is it this snowbank or is it the next snowbank? And you can go through all of these different charts. We've all seen the 3-month and the 10-year, or the 3-month to 10-year comparison in the yield curve and how inverted it is, and all of these charts are all snowbank after snowbank after snowbank. And we're sitting here with the Fed Manufacturing New Orders Index. It's below zero, and you can see in 2013 it spent some time down here, like almost a year or two. In '07 it got down to this very low level, which we got here in 2007 as we came through. And once it got down to this level, again, it tried to bounce and then failed. And so we're sitting at this very low level, below zero, have only reached this level, when things get really, really ugly. So it's an important place for us to just keep watching. Now, I could go through all of the charts in my recession watch, but most of them have a PPO rolling over near zero. So I want to take your eyes to this chart. And this chart compares two different pictures of charts that are on stock charts. And what I'd like you to notice is the similarities in the way the market behaved. So we had this big kind of shock, and then the market rallied. And then as the market topped out, the PPO started to go below zero, and it kept going below zero, and it rallied up to this level. And so we got this kind of double bottom in the PPO, and it looked pretty good. And things were starting to really get going. And then down here in the bottom, we have this same situation where we see this pattern developing before, and we see the PPO momentum. Now, I've taken the dates off this chart on purpose so that we're not confused. But what we're looking at here is, this is 2002. This is currently 2023. And when we look at this chart, what did it do right at this point? This was our double bumper in the PPO, and then right around this March-April timeframe, we got up here, and then we literally fell for 4 or 5 straight months back then. I think the change in the interest rate that the Fed has just announced, or the rate of change that the Fed is going through for the interest rates are a headwind and a snowbank that we need to deal with. But the real story here is, if we're where I think we are, where basically momentum comes up, we think everything's going to be fine, and then all of a sudden we started to underestimate how bad inflation's going to be, and this market rolls down. So whether it's this week or a couple of weeks from now or a month from now, I just don't know. The market can stay irrational longer than we can stay. So with that, I want you to think about risk happens fast, and so at least be prepared. If I'm wrong, great, but all of these charts, I don't know how many I could show you. I could find another 20 or 30. But the issue is they're all lining up that there's a problem here, and we all think everything's going to be fine. I think it's similar to trying to thread a needle using an elephant's trunk. Like the Fed rate of change here is absolutely massive. And we're going to get up to this 2007 level where we were up around 5.25%. And currently we're starting to think about pricing in 6%. So everything I've just shown you all leads to me to be a problem. What I'd like you to think about is make sure you understand where you are in your investing, and whether you're a bull or a bear, it really is up to you to how you interpret the market. But for me, I think we're sitting at a very vulnerable zone, and is all I can recommend is try to make sure that if you're prepared, everything's fine. But again, what kind of a car are we driving down the road? I think, we all hope it's going to work out great. And in 1975, in the middle of a winter snowstorm, we did make it to the house. And then we got to the house and there was a bigger problem. But my point here is that risk happens very, very fast. And so just because things have been okay, be aware of how the charts are all set up. So with that, I'll stop. Thanks everybody for joining me, and hopefully this helps explain why I might be a little bit more bearish than other people who thinks it's all going to end in roses. And maybe I'm wrong. I'm not trying to fearmonger. I'm just showing all these charts together, suggesting at least be aware of the conditions. Thanks everybody. Bye-bye.